year low, tech stocks tumbled globally, and U.S. Treasury yields violently spiked. The shockwaves from Tokyo traveled instantly through a series of interconnected financial channels, revealing just how much the global market depends on Japanese capital. For decades, U.S. government bonds have served as the ultimate safe asset, absorbing massive amounts of foreign capital and anchoring the global financial system. This chart breaks down the foreign ownership of that U.S. debt. Right at the top is Japan, holding a massive $1.14 trillion slice. They have reliably absorbed a huge portion of the bonds Washington issues year after year. By continuously buying up American debt, this steady flow of Japanese capital functioned as a hidden structural subsidy. It kept borrowing costs artificially cheap for the United States. That dynamic shifted in Tokyo. Prime Minister Sanae Takaichi recently launched a $1 trillion domestic investment blueprint designed to heavily stimulate the Japanese economy. To fund that immense spending program, the Bank of Japan had to abandon its long-standing policy of artificially suppressing interest rates. They allowed domestic bond yields to rise to multi-decade highs. This created a new reality for Japanese financial institutions. For the first time in a generation, they can earn a meaningful, positive return on their capital right at home. A pension fund manager in Tokyo no longer needs to ship cash across the Pacific to Washington to find a yield. They can keep their money in yen, completely avoiding the cost and risk of exchanging currencies. Takaichi's domestic fiscal agenda successfully incentivized local investment, but it inadvertently cracked the foundational foreign subsidy that the American debt market relied upon. That policy shift triggered a massive financial migration, known as the unwinding of the yen carry trade. Japanese institutions sell U.S. treasuries, converting dollars back into yen to repatriate funds into the Japanese bond market. As thousands execute this trade, demand for American debt drops, causing bond prices to fall. Consequently, their yields automatically rise to attract capital. That rising U.S. Treasury yield acts as financial gravity. It directly dictates the interest rates Americans pay on home mortgages, auto loans, and credit cards. As Japanese leverage exits the system, the transmission mechanism is immediate. A Tokyo bond sell-off means higher American consumer borrowing costs. Back in Washington, the prospect of this capital flight alarmed Treasury Secretary Scott Bessent. If Japan physically dumped its $1.14 trillion in treasuries onto the open market, the resulting flood of supply would send U.S. consumer yields soaring. To prevent that open market dump, Bessent urged the Federal Reserve to deploy an obscure pandemic-era tool called the FEMA Repo Facility. Through the FEMA workaround, Japan hands its U.S. treasuries to the Fed as collateral instead of selling them publicly. The bonds are stashed in a vault in exchange for liquid dollars. Japan secures intervention cash, keeping that massive supply completely off the open market. Using the central bank as an offshore pawnshop is a severe geopolitical maneuver, deployed specifically to protect the American bond and housing markets from a sudden shock. But hiding collateral in a Fed vault only buys time. It masks a much deeper structural deficit crisis. The U.S. Treasury Department is currently required to finance roughly $12 trillion in debt over the next 12 months alone. This chart maps the $12 trillion borrowing requirement against shrinking global savings. With reliable marginal buyers like Japan walking away, the Treasury must offer much higher interest rates to convince hesitant new buyers to step in. The Federal Reserve can still adjust short-term rates, but they have effectively lost control over the long end of the curve. Long-term interest rates are now governed by global supply and demand. Economists call this environment fiscal dominance, a state where the sheer, overwhelming volume of government debt overpowers traditional monetary policy. Treasury yields have become the primary engine driving global market volatility, their daily movements capable of destabilizing portfolios worldwide. When the cost of borrowing the world's reserve currency fluctuates rapidly, it threatens everything from highly leveraged technology stocks to the daily operating costs of multinational corporations. A fiscal decision drafted by politicians in Tokyo now cascades directly across the Pacific, rewriting the financial realities of the American economy. In this fully interconnected era, the price of an American mortgage is tethered directly to the breaking of the Japanese bond market.